You're listening to Lighting Up Real Estate with your host, Kendall Lockett.
I love when brands reach out to me because they want to sponsor the podcast. If you've been listening to the show, you know that I'm a book lover. For this episode, I am super excited to be working with ICRA Publishing Company. They help listeners like you become self-published authors. With one-on-one guidance and support, ICRA Publishing helps you design, edit, and publish your book into an ebook or printed in soft or hardcover. Sell your book on Amazon.com and other platforms and keep 100% ownership rights and royalties for your work. ICRA Publishing has 4 different publishing packages available, and they're customized to meet your needs and goals for your book. With ICRA Publishing, becoming an author has never been easier. If your goal in 2021 is to become an expert in your field or share your story to inspire others, I have a solution. Transform your thoughts into a well-written, beautifully designed, high-quality book. Go to iCraPublishing.com and use promo code CANDLE and get 20% off your package today. Episode 25. Today, we are lighting up financing your first home as a real estate investor. The goal of this show is to shine a light on people, strategies, systems, and ideas to help you get started in real estate investing. On the show, I have one of the best conversations about financing to purchase a home with Padi Goodspeed, also known as your mortgage girl. Just in 2020, Padi was in the top 1% nationwide in mortgage lending, funding over $122 million for people just like you to buy real estate. So she's here to shed light on the right way to get to the closing table with financing. There's a lot of gems in this conversation, so let's get started. Padi, welcome to Lighting Up Real Estate.
Thank you so much for having me. I'm honored to be here with you.
Oh, wow. No, the honor is all mine. I heard you on Clubhouse one night and you really just had me at attention. And before I knew it, I was in your Instagram messaging you. I was emailing you the next morning. I already had questions that I was going to ask. I put it out into the atmosphere like, God, I'm talking to her on my podcast. So by the time you got through on Clubhouse, I had like 20 million questions I wanted to ask because I already knew this was going to happen. Because at the same time when you were just talking about, you could just tell in how you were answering those questions, and you had that Clubhouse room open for at least 3+ hours. And you were talking to everybody about how we can finance homes and of course get wealth through real estate. And I was like, she is just so passionate about this. And you even said, like, what stood out to me was how you even talked about your principles on how to get financing and the right way to do it and the wrong way to do it. And you don't find too many lenders that are like that in this industry. So
thank you.
And that's why I just had to have you, because it's like, oh gosh, she gets it. She gets it. She's doing it the right way. She's making sure that we're keeping these properties that we're buying instead of just giving out loans everywhere. That's not what you're about. And you said that so clear. So let's get into who you are and how you got into the world of financing.
Man, so I've been a mortgage banker for more than 18 years, and I got into the world of financing. Actually, I started college when I was in 2002-ish. It was right. So I was around 20 when I got started. I was a couple years into college, and I've always been a salesperson. You know, I worked since I was 14 years old. I had to learn how to survive in a lot of different ways, and so I was just kind of lucked into it. So when I was starting in college, my girlfriends were like, hey, we know this lady. She owns this mortgage company. You need to go check her out because you guys have similar personalities. You could totally do what she's doing. And I said, okay. So I saw what this lady was capable of. And when I saw what she was capable of, I thought, okay, let me learn this business. So I literally walked into like a small office, small brokerage that was owned by a couple of guys. And they back then, like, you know, right now when you want data, you buy it from a company, you get a digital pack of data and so on. You can call people if you're trying to cold call. Well, back then, you actually go to the title company, you pull up public records the size of an encyclopedia of the homeowners within a zip code that you want to talk to. So I had to put that in front of me and call, like some of them had phone numbers, some of them didn't. You literally take that piece of paper and you're calling people and asking them if they want to refinance or save money on their home loan. And that was my introduction to the business. And within a really short period of time, I was able to, these guys that were teaching me weren't even able to convert the calls as quickly as I could. And so that was just my sales ability at play. And at that time, it was way worse for women in the business. But the fact still remains that women still can establish trust on a way deeper level than men. And so I was always producing more from the very beginning. So I quickly moved out of that setting into more professional settings with brokers. And I started my career in the broker world. Then as I learned with time, I moved over into the banking system, and I can explain that transition anytime. But that's really kind of not as important, but that's how I started. I started really from the absolute lowest level, ground up in the broker world.
Okay. So what is the difference between being a broker and also being a banker? Or mortgage lender is what we call it in Georgia.
As a broker, basically, when you're a broker, brokers are great because they have access to wholesale information. So let's say you come to me. It's like going to someone and asking them to shop for you at Whole Foods as opposed to going to Whole Foods to pick up your own groceries.
Got it.
So brokers are the DoorDashes, the Postmates, and the, the DoorDash, Postmates, and what was the other one? I don't know what they're called, of the world, right?
Because the Instacarts.
Your Instacart. Yeah. You're paying them a premium to go do the job for you. Doesn't mean they're not going to access that same organic fruit. But if you walked into that store and you saw the organic cucumbers and you saw the regular cucumbers and you saw another one for sale, you're probably going to go pick up the organic cucumbers that are for sale because you're going to save 50 cents on that. But you're not the one picking the product. You're trusting someone to go in there and pick that product for you. And sometimes you're saying, I'm going to save $500 by doing this, but you're not the one who's analyzing the lender and choosing who you're working with. So that's really the main difference. So some brokers have a concentrated amount of business that they're doing with one or two lenders that they're working with. So they do understand the workflow. They have preferential treatment. They might have better pricing with one over the other. And so the broker world is not bad by any means, but the broker itself is not the lender. The broker is the Instacart. The broker is the shopper. So whenever there's an issue, that shopper has to go get in line just like a customer to go ask the manager to solve a problem. When you're working in the company, if you're the teller, then you know exactly where to go in the back room to walk upstairs to the manager's office and say, hey, this is a problem I need to solve right now. That's really the best analogy I can give you. So if you're hiring a third party advocate when you yourself can be working with the lender directly for better service. So, and also in the broker world, at any given moment, any relationship that they have, any lender can just completely shut down and decide not to fund deals. When you're in 2020, when the COVID pandemic, when the pandemic just hit, a lot of brokers who had deals on the table completely shut down. Overnight. So if you had a 580 credit score or a 600 credit score and you had an FHA loan in place and you were at the funding table, your deal just died because that lender, all of a sudden their resources were pulled off the table and the broker you're working with is calling you saying, I'm sorry, I can't close your loan. Wow. It happened multiple times. So then that problem is not exclusive to the broker. So again, when the pandemic hit, Wells Fargo took millions, we're talking millions of deals that were on the signing table and completely shut them off. So this exists everywhere in the case of an emergency, but again, the broker has the least amount of control over the situation. So now you have something in between. You have the bankers and then you have the credit unions. And banks and credit unions, the challenge that they present to the consumer is that they have their own money from their depository that they're lending out to you. So it's not a credit line. This is money that's in their institution. So it's cheaper at times, but they can also write their own rules. So in 2007 and 8, when the banking system and the real estate crashed and all of that stuff happened, the banks are now held to a higher credit standard for the mortgages that they write. They have to meet a quality control checklist, if you will, in order to be considered a qualified mortgage. So when you're a bank or you're a credit union, you can say, so let's say FHA will give you an approval to 57% back-end debt ratio. Let's say that VA will go to 60%. Let's say that Fannie Mae will go to 50 and Freddie Mac will go to 50.5 on the debt to income ratio. Well, the banks can say we're 43% across the board. So that means that if your debt to income ratio exceeds 43%, regardless of the agency guidelines, the bank will not exceed that threshold because that's the risk threshold that they've put in place for their money because they want to mitigate the risk so that their money is not given to someone who could possibly have more likelihood of a hardship that would cause them to not make their mortgage payment. So everything about mortgage lending is all about the risk. That's why we're analyzing how much someone's putting down, the market value, even sometimes what's trending in that neighborhood. If it's a declining zip code, it could have a factor in the way that the banks write rules. That was also a factor back then, and it was reintroduced during the pandemic. There was like this big halt, like, let's be careful about what's happening in certain regions over others. And then at the same time right now, how self-employed people are taking a hit. Why? Because, well, it's the nail shops and restaurants that took the biggest hits, right?
Right.
But if you're an attorney and you're self-employed, we can't say, okay, only if you own a restaurant, you have to do this. It doesn't matter who you are. Every single person who's self-employed is treated the same way with the new guidelines, and they have to jump through extra hoops to prove that their income is stable and that they can continue. So that's what it's all about. Now, in the middle of that, you have something called correspondent lending with mortgage banks. So like Guaranteed Rate, the company that I work for is a mortgage company. So mortgage companies have a system. So where you applied for this mortgage, I'm looking in this system and I'm pulling up 10 different products that meet your criteria, the top 10 best priced options for you. One might be from JP Morgan. One might be from Goldman Sachs. One might be from Bank of America. Another one might be from the Pentagon Federal Credit Union. So I'm looking at these options that pop up. In our world, those are called investors. So we fund the loan with our own money and we sell the servicing to that company. So we can write based on expanded guidelines that we're willing to take the risk on because we're funding it with our money, but we're delivering it to them because it still meets their criteria. Now, in the mortgage banking world, you have the best of both worlds. You have the access to all of the different options of an expanded guidelines, a big pool of products. And at the same time, they're funding with their own money. So the processing is extremely efficient and you don't have to shop around to 10 different places to make it work. So in my personal opinion, after 18 years of originating, it's the easiest to accomplish something at scale in the mortgage banking space. If you go to write an offer right now and you have to be, in order to be approved, you need to write a non-contingent offer with an 18-day close of escrow or a 20-day close of escrow. That's not happening at Bank of America. That's not happening at Chase, and that's not happening at Travis Credit Union. Okay.
Right.
And on the broker side, you're still taking a major risk because if that broker decides to, let's say, cut pricing and take in $100 million worth of new refinance business, your loan processing is going to be pushed back and there's absolutely no control over it. So the mortgage banking is the middle ground, which I think is the best place to do business.
I agree. I definitely agree. Yeah, see, I do. Kindred sisters right here, because I definitely agree with that. Because especially when I had buyers and they said, oh, yeah, I'm approved with this bank. And I'm like, no, we're not going with the bank. Oh, I've got this broker. No, we're not going with the broker. Or even like the Quicken loans. That is something I don't agree with them to use, even though they go, oh, I got instantly approved online and I'm talking to this person here, talk to them. No. Not the same.
Not the same.
Okay. So even with Quicken Loans, like what can you explain to listeners, like why Quicken Loans is not, or is it Rapid Mortgage, Quicken Loans?
Rocket.
Yep. Rocket. That's the one. Like why they're not good ones to use when buying your first property, your first home.
Rocket Mortgage is Quicken Loans DBA, I think. I'm not exactly sure what the legal structure of that is, so let me be careful what I say. But here's the thing. Many companies have sought to disrupt the mortgage space.
Yes.
Quicken being one of them. So Quicken has basically a call center model. So you have this huge call center of people that will take your call, just like a bank. If you walk into a bank, and that I cannot tell you how many calls I get on a weekly basis from someone who got pre-approved instantly at a bank. And then what happens is after it goes to underwriting, all the problems come up.
Yes.
Well, the initial person that consults you on your mortgage has to not just be an application taker or a paper pusher. They have to understand the guidelines. The problem with Quicken on the retail side is that if you contact them and you get an instant quote online, unless you have a flawless approval process. Let me explain what that means. You're not going to get far with Quicken because the moment a problem arises, it becomes a dragged out situation. Then you have the problem of not having localized appraisals. Now, the appraisal world is nobody can select an appraiser. Nobody can say, I want you to work with this appraiser.
Right.
So at Quicken, when you're working with them, They're a nationwide company and they contract through what's called an AMC, an appraisal management company. And oftentimes these institutions create their own appraisal management department, which is separate and apart from any originations or operations. Now, what they do is they use a national resource directory for appraisals. And let's say that when an order comes in, you have to present that order to 5 appraisers. The first person to accept it gets the order. Okay. When you're doing that, if your property is in, what state are you in again?
Georgia.
You're in Georgia. So, let's say give me a city, maybe 15 miles away from Atlanta.
You would probably say Fairburn.
Okay. What was it called?
Fairburn.
Fairburn. Okay. Fairburn. Yeah. Okay. So if the subject property is in Atlanta, but Quicken hired an appraisal from Fairburn, or if it's in Fairburn and they hired one from Atlanta, no big deal, right? I mean, it's only 15 miles away. But if they don't know the neighborhood, it makes a big difference because real estate is one of the only industries that's extremely hyper local. So you might be qualified to sell a home 15 miles away or 20 miles away or 100 miles away, but the appraiser might not be qualified for that neighborhood just because they're based out of Atlanta. They might not have any clue about what's going on in terms of data or trends in the others. That's just like the most simple example I can give you. Yeah. So many, many reasons why realtors don't like to work with Quicken or don't like to work with those big banks is primarily appraisal issues and then delays with the closing. So when you have companies like Quicken, they don't care about the one guy who has that one special story because 80% of the business that they drive in is clean business, clean A-paper business, which I'll explain. So they just care about capturing that. When they decline a loan, they don't give a shit about sitting on the phone with you for the next 35 minutes to hear your story and collect the paper trail and figure it out and piece it together to get the deal done. Even though it meets the guidelines, they don't have the time for it. So you're never going to have a personalized service on there and you're never going to have a close enough reach to the underwriter to make that happen. I've brokered loans to Quicken. The easiest loans have gotten extremely complicated because of that exact reason. I'm not speaking from hypothetical experiences here. I've done it. So what that means is if you're a wage earner, let's say you've been on your job for 5 years. You have one bank account that has $100,000 in it. You're buying a house and you've never changed jobs. You're plain as day. You have your paycheck stubs, your W-2s, your tax returns. You've never had a side gig. You've never made a deposit. You never transferred from one bank to another. You're a Quicken customer all day long. Your file will go smoothly. You might have problems with your appraisal, but so on. But most people just aren't like that. Most people have, okay, I have a business and I have this corporation. I have this job and I switched jobs. I have 16 bank accounts. I just sold stock.
I have student loans.
Yeah, I have student loans. Exactly. So everyone has a story.
Yes. Okay, so let's start. If we have someone listening right now that has not purchased a home yet and they want to buy a home in 2021, but they are also, of course, listening to this podcast, they want to be a real estate investor. What options do they have in first home ownership with the possibility of investing, like far as the financing opportunities that are available?
So for first time home buyers?
Yeah, for first time home buyers, what type of fancy? I mean, I know, but this is not my lane. This is yours.
Well, first time. So one of the things I love I didn't know how big of a misunderstanding this was until Clubhouse, but FHA financing is not a first time home buyer product.
Yes.
FHA loans are designed for anyone who intends to occupy the property as their primary residence. It's not for a second home. It's not for an investment. So please, guys, stop talking about house hacking and buying your first investment property using FHA financing. You're going to get yourself caught up. There's way too much of this dialogue happening on Clubhouse, which means it's happening everywhere offline. And it really, truly needs to stop because people are listening. You never know who's listening. So FHA loans are designed for people who want to purchase a home that they want to live in as their primary residence. FHA allows you to put 3.5% down, and you always need to budget at least 3% of the sales price for your closing costs, unless you're using some sort of grant or down payment assistance program, which are relative to the city, county that you're living in. I think Georgia has a Georgia Dream program, for example.
We have the Georgia Dream.
And the Georgia Dream program, and from what I've heard from other real estate agents, is that most offers don't get accepted with those because of the time frame that it takes to execute.
Yes.
And I haven't fully looked into that program, but I did look into one that was from North Carolina. And the North Carolina Down Payment Assistance Program will give you $8,000 to use for your down payment and closing costs. They're not going to charge you interest for it. You get a higher interest rate on your loan for using it. And also, when you go to sell your house, there's a recapture clause. Yep. They will take 6.25% of the loan amount or 50% of the equity gain that you had, the lower of the two. So based on how the market is going, let's assume that market is still going to be the same way. The market's still growing. So you're probably going to have more equity growth than not. So if your loan amount is $125,000 and you took an $8,000 down payment assistance program, and I'm just using low numbers, you owe them $9,375 of your money. Yeah. So let's say $250,000 loan. If the loan amount is $250,000, which is also common for that market, you owe them $15,625 of your equity. So when we're excited about getting into the property, we don't care. We just want the keys. I got to put it on Instagram. I got a floss. I got this house. That's the mode. We all do that. We all do that. I do that. We all do it. We have this sense of urgency to get our foot in the door. So we sign up for these programs. And then what happens, what you're going to be pissed off about is when you go to sell it because you wanted to upgrade or do something else with those proceeds. And now you have to write a $15,000 check back to the program because they did equity sharing with you. So people think that I'm against down payment assistance programs. No, I'm not. I'm against us educating ourselves prior to getting into a contract. I want to heighten the awareness around these products and these programs because I can tell you that there are communities out there that band together to establish generational wealth amongst their people. And not a single one of them will pay a dime over in fees or extra interest rates to get into the front door. They'd rather come together and do whatever it takes, even if that means 15 people living in the house, rather than paying more interest to the banks. So we have to start having a conversation about breaking down these barriers of competition between us and our communities to say, if we come together, if you're going to split the pie with somebody, wouldn't you rather split it with your aunt, your cousin, your mother, your sister, your neighbor, and then the program, then the system, then the money, then the down payment assistance program? So I want us to be aware and say, let's start keeping those bits in our pocket. Now we're not talking about large sums of money, but it doesn't matter because they add up. When we're talking about net worth, we're talking about what we have minus what we owe. And that's the number that we're looking for. So we have to pay less to get our foot in the door so that we owe less in the long run so that we can have more equity. If you want to close the wealth gap, you have to start paying less for the same thing everyone else is buying. So I always say on the call, if you're buying a piece of gum, we're walking into 7-Eleven and I'm buying that gum for 50 cents. Why the hell would you come behind me and buy the same pack of gum for $1?
Wow.
That's all I'm trying to say.
Yeah. Okay. So I'm glad you put that out there. No FHA. So with conventional, what do we need for us? The credit scores, the documentation, like how can we qualify for a conventional loan?
So conventional loans are, if you're a first time home buyer, you've never purchased before, the down payment on the conventional loan is 3%. So it's a little less than FHA. The biggest difference between mortgage insurance pricing on FHA loans versus conventional is that the cost is much higher. So if your credit scores are lower. So the benefit of the mortgage insurance pricing with FHA is that if you have a 620 credit score, your mortgage insurance is going to cost the same as someone with a 720 credit score. Because it's a fixed rate from the government. If you have conventional financing and your credit score is a 620, your mortgage rate will be almost double. The mortgage insurance rate will be almost double than someone who has a 720 or 730 credit score. The difference is on the FHA loan, to make up for that, they're charging you an upfront mortgage insurance premium. So let's go back to the $300,000 purchase price model that we have with the FHA loan. The loan would be $289,000. Okay. You're adding to that $5,066. So let's say that it takes you 7 years to pay. It takes you 7 years to pay off pay down your mortgage and get rid of mortgage insurance, just for an example. So if you're paying that extra $5,066 in your upfront mortgage insurance premium, if you might as well be paying an extra $60 a month anyway. That's hard to comprehend on a podcast. But my point is that mortgage insurance on FHA loans has a fixed rate system, regardless of your credit score. But they also have the upfront mortgage insurance premium, which is 1.75% of the loan amount that gets added to the loan. So that means that you're going into it with paying the monthly mortgage insurance and owing more. So if the down payment is 3.5%, but they're adding 1.75% to the loan amount, you're actually you're only getting credit. This is just the best simplistic example I can give.
Yeah.
Your 3.5% is now only worth 1.75%. It's like they're taking half of your down payment directly for the mortgage insurance premium off top from the very beginning. So do we like FHA financing? Absolutely. FHA is amazing. FHA is wonderful. It lets you get into that 4-unit with only 3.5% down. We love FHA financing. But if you don't understand that, I don't want you to get it. I want you to understand the difference so that we can say, okay, if I get FHA, this is what is going to cost me over the next 7 years or 10 years. This is how I'm going to get out of it. This is how I'm going to pay it down. This is my exit strategy. This is my cost. And now at the end of that, I realize, okay, this is going to be more profitable for me. And you compare that to conventional, because that's what people do when they're watching their dollars. No one's going to watch your dollars like I watch your dollars. The bank makes more money, right? I mean, I'm sorry, no one's going to watch your dollars like you watch them. The banks make more money when you go with a government insured loan. So we prefer someone, if I was speaking directly from my own bottom line and the way I make money, I'd rather do 100 FHA loans a month than a conventional, but it's not better for you. It's better for me. So think about that when you're making that decision and just educate yourself. It doesn't matter what you choose as long as you know what you're doing and you have a plan, and we're not just thinking about the right now.
Wow. All of that is amazing. I mean, I'm taking notes and oh my gosh. Yeah. Your passion is just on 10 and I just love this. Okay.
Okay. My kids always think I'm yelling. I'm like, I'm not yelling.
No,
I'm just talking.
No, it's your passion. I mean, but you're telling the truth though. I mean, this is what we don't hear. I'm just here for all of it. Like I said, I'm just sitting back and I'm just listening because this is amazing what you're sharing with us, because we don't have these conversations, and the truth will set you free, and you're telling the truth, which is why I wanted you here. Okay. So how do we deal with student loans? Because let's get rid of the myth. Will that keep us from getting a house?
No, student loans won't keep you from getting a house, but deferring them forever and also ignoring them will keep you from getting into a house. Okay. Now, student loans, in my opinion, have created the biggest barrier to entry for homeownership that I've ever seen. Okay. And with that said, we have to start talking about this more because there are too many people that are using student loans to survive. I mentioned this in a room and someone was like, I'd rather have you take the money from your student loan and use it as a down payment to buy a house than go with the hard money loan and this. And I just thought to myself, really, we're out here encouraging people to go out and get more debt rather than spending the next 5 months saving $6,000 to go make a deal happen. I honestly, I couldn't believe it. And maybe there's a different school of thought. Maybe there's something I don't know. But I also spoke to a woman who makes $38,000 a year, who has $250,000 in student loan debt getting her PhD. And I'm going to tell you right now that when she finishes the PhD, she'll probably owe more, and her salary is going to be more like $60,000 to $70,000. Right. Tell me how that's justifying. Now, she admitted to me that she needed that money to survive. Now, my question would be,
she's taking out the full amount to pay bills and
feed her kids. So if you ask me, if that was my sister or my cousin or my best friend that I'm having the conversation with, I'm just going to ask you, why is it important to you to get this PhD? What difference does it make? What's the end game? When you get the PhD and you get the $75,000 salary, are they going to forgive your student loans? Are they going to pay this back? I simply, honestly, just don't understand the thought process. So I think we need to have conversations about that so we can understand why they do it and how it's benefiting them. And it's probably just an easy way to get checks. I remember back in 2005 and 2006, before everything crashed, these lenders would send you a check to your house for $5,000. And it was a real check. All you had to do was go to deposit it. And by depositing it, you had that money and now you owed them money at like 150% interest.
Yes.
Who the hell is going to get a $5,000 check and ignore it?
Yeah.
Nobody. And that's what the student loan game does to me. They're offering the students money. And I enrolled myself full-time I go to full-time junior college myself. A full-time schedule would cost you $700 for the classes. Mm-hmm. On top of $700 for the classes, let's say you got to spend another, let's say $1,000 on books and materials, right, pencils, whatever. So a semester at a community college should not cost you more than $1,800. Now, let's say at a higher institution, it would be $5,000, right? So essentially, if you're going, let's say you're going for, you go three semesters a year and you go for 6 years. Okay. That should cost you something around $90,000 if you're covering your housing as well. So, and that's over 6 years. I don't even know if that number makes sense because I've never done it. I never took a student loan. I don't know what that is. And again, keep in mind, I had to work since I was 14 years old. I dropped out of college a couple times. I've never gone that route, but I still don't understand the psychology behind it. So when people have a massive amounts of student debt, it's easy to ignore it. If someone who's listening to this has that student loan debt, they would need to contact the student loan office if it's delinquent and say, hey, I need to get on the 9-month payment program that is affordable to me. So let's say you agree to pay $5, $20, $50. Right. As long as you make that payment on time for 9 months, they will reinstate the loan. So it'll no longer be delinquent on your credit report. It'll be reinstated and paid as agreed. And then you can go into an income-based repayment program. It'll be an affordable payment based on your gross income. And they take a look at that. They're not going to take a look at your grocery expenses and your car payment. They don't care about that. They make the payment based off of your gross income. And when you get that in writing, it really reduces the amount that we have to use to qualify you for a home loan, but there is a deeper conversation to be had there about why people are using them at the rate that they are.
Right. So are we being affected if we have student loans with, I guess we just got an extension with the new Biden-Harris administration to where I know they've extended it for so many more months now.
I thought it was through August 21st. I haven't paid much attention to any new policies as of yesterday, other than the fact that taxes are going up significantly. So in that case, if you're trying to buy a house and your student loans are in deferment, unless HUD changes that policy and Fannie Mae and Freddie Mac change that policy, which might happen with this administration, you have to get into the income-based repayment program. Okay. As of right now, that's what it is. But there is a strong possibility that can change. Why it would change would be they would before this last administration changed the rules. What happens is if there's no payment that shows up on your credit report, it shows up as 0 because it's deferred. As long as you prove that you were in school and it was going to be deferred for another 36 months, 24 to 36 months, we wouldn't have to hit you with the payment, because the idea is when you got out of school, your income would go up and it would not have an impact on your ability to repay your loan.
Right.
Now they don't care about how long it's deferred. They want to have a simulation of a payment so that they can adjust the risk of your ability to pay back your home loan with that included. So that's the thought behind it. We have to make sure eventually you're going to have this payment come up. So we need to make sure that it's within a reasonable range and we're mitigating that risk there.
Okay. So what if I wanted to buy a multifamily? That would be my first property where I would live in it myself and then also rent out the other units. What type of loan? I could still get the conventional loan in order to buy that.
Conventional or FHA. Yeah.
Okay.
So if you have, and that's for a multi-unit, right?
Right.
Yeah. So if you wanted to buy a multi-unit property using FHA financing, you can use the rent in your favor. Now, if you're using conventional financing, Fannie Mae and Freddie Mac, they want to see that you can document that you have managed a housing payment for the last 12 months. So let's say that you lived in an apartment. They won't let you just use it anymore. If you lived with your mom and you're buying your first home, you can't use the rent. If you lived in an apartment complex and you've paid your rent on time for the past 12 months and the management company can verify it, then you can use the rent. If you didn't live in an apartment, it's not an official management company, but you had rent anyway. Let's say you lived at grandma's house and you're still paying grandma $500 a month in rent. As long as you can document it, I can show consistent rent coming out of your account at $500 a month, then I can use that as well. The housing payment has to be documented and there has to be a lease agreement associated with it. So basically they're trying to document that you have the ability to make your payment. And then they'll allow you to use the rental income from the subject property to offset the mortgage payment.
Okay. So do we need to already be approved with you before we start looking at the property, or how do you think that should work?
Yes, you always have to have your approval done prior to shopping, because in this COVID environment, a realtor you have to sign an attestation for your COVID. You've got to wait to get into the house. You got to do this and that. And on top of that, there's not even a lot of inventory. So the competition on the property that you're looking at is unbelievable. It's high. So if you're not qualified, the agent just doesn't have the time to invest in taking you to 17 different houses. So if you want to have the highest level of service from your realtor and you're serious about shopping, you have to have your pre-approval done. You have to have your paperwork in, and you have to have the estimated amount of funds due for the transaction available to you when you start shopping. Not like, oh, I'm hoping for this check from the insurance company that's coming in 6 months. You've got to have the money in your hands, because you might like a house and it's going to go fast. Yeah, that's true. So as far as verification, like what items do we have to turn into you in order for us to get approval? So it starts with your basic loan application, and that loan application verifies your identity, your employment, your residential history, your income, your assets, and your liabilities from your credit report. So let's say you fill out an application and you tell me you work for NASA, you're an astronaut, and you make $200,000 a month. That's great. I'm going to spit out an approval letter. But if we can't document that, the approval letter becomes null and void. So you have to make sure that when you present your income information, that it can be documented with your paycheck stubs, W-2s, tax return. And let me tell you how ridiculous mortgage processes are. So if you have a job, I have to not only get your updated pay stubs, I have to get your I have to get your W-2s, your tax returns. I have to verify your tax returns with the IRS. I have to verify your W-2s with your employer, and I have to verify your current pay by phone with the employer. And then again at closing. So some people will be like, I just gave you the pay stub. Why are you asking for this? I don't know. Write a letter to Fannie Mae because we don't like it either.
Yeah. Okay. So how do we know how much we can afford? Like, is there a way that we know before you guys know?
That's tough that's tough, but I can give you an idea. Okay. If you take your gross income, so let's say your gross income is $65,000 a year if you're a wage earner, not self-employed. And you divide that by 12, take your gross income, divide it by 12, and take 45% of that. That's your maximum mortgage payment. So again, so we take your gross income of 65,000, divide it by 12, and then multiply that by 45%. Your maximum mortgage payment would be $2,437, including property taxes, homeowners insurance, and HOA. So that's a good gauge there. Now take that same $65,000 and you divide that by 12. Okay. Then you take that 54, let's just call it 5417, and you multiply that by 50%. Your entire outgoing expenses cannot exceed that 50%, 2708. So now that means you had a house payment of $2,400 with property taxes, homeowners insurance, HOA. That leaves $300 a month for your student loan payment, car payment, credit card payments, etc.
Wow.
So your debt to income ratio, in some cases it can exceed that. But if this is the number you're using, use 45% of your gross income for the max housing payment. Use 50% of your gross income for your max payments total. All of the payments you make according to your credit report, including the property taxes, homeowners insurance, principal, and interest, cannot exceed 50% of your gross income. If you use that measure, it'll always give you a good idea.
Okay. That is great. Okay. So, you've given us so much. So let's say we want to get the multi-unit, or we've already have our business license. Can we use that to purchase our house and put the business name in the loan, because it will be for a multi-unit and we don't want to be tied?
No, when you first purchase a house and let's say you come to me and say, Patty, I just established an LLC for the sake of my property and I want to buy a house using my LLC. You're now asking for a commercial loan, not a residential loan.
Wow.
And the minimum down payment would be 20%, in some cases 25, in some cases 30. So in the commercial financing, the loan has to be closed in your name. Then you have to go consult with an attorney and talk about the transfer of title for a measure of protection. Now, so let's say that we have Candlelight LLC. You just bought a property and it's a 4-unit. You're living in one, you're renting out the other. You used FHA financing. Then tomorrow you're going to go to the county and say, I want to take the title of this property and I want to move it into Candlelight LLC. Mm-hmm. So when you move the property in there, the reason why you're doing it is because the reason why people talk about this is because they want to mitigate risk. Meaning that if your tenant in unit 3 falls down and God forbid hurts themselves and they sue you as the owner, they're not suing you as your person. They're suing the owner. That's an entity. And essentially that entity doesn't have any assets or whatever it is. So the risk is lower, right? That's the idea. That's why people are talking about it. The other reason they're talking about it is to say, go get an LLC, go get an LLC. Why? Because you can go to if you're finding a property that's significantly undervalued, and you can put lower money down on it. Like, for example, you find a property that's worth $100 and you're buying it for $60,000 and 25% of that is only $15,000. You can do that under your LLC as long as you have the down payment. So you can go get financing that's under your LLC and that's going to cost you more money. So before you guys get the LLC and from LegalZoom in 5 minutes, you have to contact an attorney and just have a consultation. A $350 consultation with a business law attorney will explain to you exactly what you do. Because if you take a property and you transfer the deed, if you take a property that you said was your primary residence and you transfer the deed into a corporation, there is a chance that the bank can call that loan due.
Yes, that was my next question.
Yeah, you're transferring the ownership. Well, they just qualified you for that loan based on who you are. So they don't know who that is. So that all has to get cleared up. Now, that doesn't happen. It's not common that it would happen. It would be more likely to happen if you don't make the payments. But that's the thing. Insurance. You never need insurance until you get into a car accident, God forbid. You don't need life insurance until the absolute unexpected happened and everyone's doing a GoFundMe. And that's just reality. Last night I did my Get Your House in Order seminar with our panel. And I'll tell you guys about that. So Get Your House in Order is a workshop that I've taught with Felicia Duncan, the founder, since for the last 5 years. Okay. And in this setting, what we do is we educate people with an estate planner on exactly what it means to buy a house, why it's important, and then how to protect that asset with insurance and estate plan, et cetera.
Nice.
And there was a family that just went to the beach. It's COVID. They moved out of the city because of COVID. They were trying to live a low key life. They went to the beach. The waves were so intense on that day that the kids got swept away by the wave. Dad and mom ran into the water to save them. Dad made it back out because some bystanders were able to pull him out, but he didn't live. He got out of the water, but he didn't make it. And the kids were completely swept away. They had just bought a house. Mom survived. She just lost her entire family and with no warning. I mean, God, this is just the most difficult story. And she wasn't on the deed. She wasn't on the loan. They didn't have an estate plan.
Oh my gosh.
Now who gives a care about the business part of it, right?
Yeah.
God bless their family. My God, just broke my heart, this story. And so our estate planner was sharing this with us. So we're talking day and night about the importance of saying, when you get the asset, protect it. You need an estate plan. You have to have a revocable trust set up. A will is not enough. Otherwise, in this particular case, she's going to lose a significant amount of money to the probate system because none of that was in place. On top of everything she got to deal with. So I'm saying that we don't expect these things to happen. So you never need something until you actually need it. So when you're being taught to go transfer something to an LLC and you're using an LLC for this and that and that, listen, someone on the internet is not paying your bills. I'm not paying your bills. I don't care about your situation the way you care about your situation.
Exactly.
Please hire an attorney and talk to them about your business structure, because that $350 that you spend for that consultation will save you 25% of your equity down the line when you're trying to build. We're talking about generational wealth.
Yeah.
Generational wealth is not just about a transfer of an asset. It's about education. It's about a mindset. It's about elevating our understanding. I didn't know any of this stuff growing up. If I did, I'd be 10 light years ahead. But I didn't. Right. I didn't have anything. My parents were immigrants, worse off than most people because they didn't even understand the language or the culture. I didn't even start to realize what this stuff meant until I was in my mid-20s. So a lot of people were further ahead than me. That's why I feel like the education is so important. For me, the generational wealth means that I'm teaching my children so that when they inherit what I've left behind, they actually know what to do with it. So,
exactly. Yeah, and you're educating them.
I'm trying.
Yeah.
These kids listen, but
Yeah.
but
Yeah.
I'm sorry I went on that tangent because it's important.
No, you're right.
The LLC business that people are talking about, you guys sit down with an attorney and please figure out what you're doing before you do it.
Yeah, that is some great advice. So, Patty, how can we qualify to buy a house after we have just finished bankruptcy, either Chapter 7 or Chapter 13?
So if you have a Chapter 13 bankruptcy and you have currently made your payments on time for the past 12 months and you get written permission from the court, you are then available. You may then at that point get FHA financing, but you have to get permission from the court. They have to say that it's okay for you to go out and get a new mortgage. Okay, so if there's a Chapter 7 bankruptcy, then you have to wait 36 months after the discharge date. So 36 months after the discharge date from the bankruptcy using a Chapter 7. Sorry, it's a lot of details in that to get in my head. And then you have when it's conventional financing, it has to be 7 years.
Question. Recently, I had a friend of mine. She's wanting to list her current property and buy a new construction. And she has been, I'm not going to say she's not been denied. She's been delayed because she took advantage of us. What is the term? I want to make sure I get it right. With COVID, we were able to I think so many households, millions of households did it, but they were able to take advantage of putting our home loans on, a deferment.
Yes.
And so now because she did the deferment, she didn't know that she is not able to qualify for a new home.
Well, how it works is, I know when they first started talking about these deferments, I remember my Facebook post, I begged people, don't do the mortgage, do everything but the mortgage. Please, please do your car, do your credit cards, do your rent, do anything but the mortgage. And the reason why I did that is because if people want to go out and buy another house, it's like a loan modification. You have to pay it current.
Yes.
So in most people who did it, now let me ask you this, and not to put your friend's situation on blast, but if she put her payments in forbearance and she didn't lose her job and she's now that means she has the financial ability to go out and get a new property. Why did she go into forbearance in the first place?
It was just I'm guilty of it as well. I did one of my properties like that. I mean, it just seemed like, oh, you could just put it on. I didn't see your Facebook post. You could just put it on, on deferment right now for COVID, because from my understanding, it was just like save as much as you can. Don't put any, and so a lot of us took advantage of it. So when she told me, I was like, oh, well, that should be okay. We'll see what the lender says. And then when it came back, I was like, oh my gosh,
you have to pay it in full.
Yeah. Yeah.
Some banks will not touch it. Now that goes for the investor. What I mean by that is, okay, so in the broker world and in the correspondent banking world, someone buys the loan.
Right.
Now the institution that buys the loan, such as the Wells Fargo's or the Bank of America's of the world, they're the ones who send the monthly bills and do the servicing. Some of them will not touch a loan that has a forbearance in it. So right now, and if you want to refinance or you want to purchase, it's okay if you had it, but it has to be paid in full. You can't have a deferred principal amount due. So it doesn't exclude you, but you have to pay it in full. So then the money you thought you were saving, you're not saving.
Exactly.
That's the problem. Yeah. That's the problem. I was like, people are thinking they're going to save money. No, you're not going to save money. It's just deferring it. It's like you're just pushing it to the end of the loan. Some of them will call it due. Some of them will add it to the payment. Some of them will add an additional payment structure to pay it back. And most of them will add it to the end of the loan. But if you go apply for another mortgage, the bank is that was the big question. How are the banks going to look at it when you go out and apply for a new loan? Wow. It's a modification. So back in 2007 and 2008, when people had modifications, what happened was we had to wait they had to show that they made 12 payments on time with the loan modification that they did to stay in their homes before they could qualify for a refinance or a new purchase.
Okay.
So the big question was, how do we approach this? How do we look at it? What do we see? Well, if you can get up here and apply for a new mortgage because you're telling me that you've got your ducks back in a row and you can afford to make the payment, then I need to see that you've made this loan, that you've made good on this loan and that you've brought it back to current. So that's kind of the current compromise. compromised.
Okay. Now, are we able to sell the property? Would she have an issue with her being able to sell it? Let's say she just moved in with her mom to save money. Could she still sell it, or is there a lien on the property because she did this forbearance?
There shouldn't be a lien. No, she can sell it. Selling it won't have any impact on it at all. There's no restriction. Yeah.
Okay. So I'm hearing about this new for entrepreneurs. It's something called this is like the term for it. I don't know the official name, but it's like the paycheck self-employed.
PPP?
No, this is to qualify to get a house. It's something like the paycheck approval, where if you're an entrepreneur, they look at or your bank statement. I think that's what it's called. The bank statement approval.
Mm-hmm.
Is
bank statement loans.
The bank statement loans. That's what it is. Okay. Can you tell us the truths and the myths about this? Because it seems like it's too easy, but I'm like, no.
It is pretty easy. So let's say you are self-employed and you provide me your tax returns and you made $20,000 net. Mm-hmm. Okay. And I said, you don't have enough income on your tax returns. Why don't you send me your 24 months, 12 to 24 months? There's programs for both. 24 months will give you a cheaper interest rate. So if you give me 12 to 24 months of bank statements, I analyze each one. I look at your deposits and I look at your withdrawals. I look at the percentage of ownership in the company, how many employees you have. And then we take the average of the deposits minus the withdrawals, and we come up with a number. So I have a client who's a doctor. He's been a doctor for more than 10 years. Mm-hmm. He owns his own practice now in addition to working for a hospital. Because of that, his income was negative $200,000 on paper. But when I looked at the bank statements, I was able to qualify him based on $47,000 a month in income. So what that means is if you are self-employed and you've kept your business bank statements and you have not commingled your funds and you've got your stuff organized and you can put 15 to 20% down, then yes, you can use bank statements to qualify.
Okay. You said a word that kind of hit me right in the side, commingling funds. Mm-hmm. And I had a client that was buying a house and kind of got caught up in the commingling of funds like 3 days before closing. And of course, we weren't able to close the deal. Can you talk about exactly what that means? Because my client had no idea that was commingling. So can you just talk about commingling funds?
Yes, I can. So basically, so give me an idea of a business.
Let's say a car dealership. You own a car dealership. That was my client.
Okay. So if you have a car dealership, you're selling cars and you've got money that's coming in from the sale of the car, and let's say it's called ABC dealership. Mm-hmm. Okay.
Yep.
So at ABC dealership, you've got money coming in. Now, I'm looking at your 12 months of your business bank statements, and I say, man, there's only $900 in this month and only $4,000 in that month. And then you say, oh, that's because that month I took the $10,000 and I deposited it into my personal account instead because I needed to pay my bills. Mm-hmm. That's commingling, right?
Right.
So if you have a business, the money from your sales goes into your business account, and the money that you pay yourself is considered to be a distribution. So the $10,000 should have went into your business account. And then let's say on the 15th or the 1st and 15th of every month, mm-hmm. you sent yourself $5,000. Now you have a clean paper trail of monthly distributions that pay you. So when I'm calculating your income and your qualifications, and I say, okay, so you have $5,000 that are coming out of on the 1st and 15th that goes to you. Mm-hmm. So now when I'm looking at it on your business side, that looks like an expense, but it's income you're paying yourself. So I'm going to add it back into the equation and consider it profitability because you're 100% owner. So I hope that was as simple as it can be. But basically commingling is if you got a check from your business, don't put it in your personal account. Yeah. Because if you're not going to claim the income on the tax returns because you don't want to pay taxes, and you're not going to keep your business affairs in order in your business bank statements, well, then you're really making it hard for yourself. Because going out and getting a loan is about establishing you're documenting the ability to pay back a loan. So it has to show stability, and you've got to show stability and consistency with your business. If you're not going to do it on the tax returns, you got to do it on the bank statements.
Yeah, that's an excellent answer. I love that. Yeah. So where's the best market right now in the U.S. to buy real estate, in your opinion?
Oh man, I don't know. I think that from what I've learned so far, I think North Carolina is really one of the hottest places. I think Texas is booming.
Yeah.
I think Florida is going to be Miami. There's a huge push to get Silicon Valley folks and all the technology that's been really dominating in California over to Florida. So I think Florida is going to have some exponential growth in the next few years. And as always, my heart and soul is with California. You can't go wrong with California. You gotta pay a much bigger price tag to live out here, but you can't lose.
Awesome. Yeah, I believe it. I believe it. So how can we get in touch with you? If you want to work with you and you be, of course, our lender, how can we find you?
Yeah, thank you. So my website is yourmortgagegirl.com. And I say this to everyone I speak to. Mortgage has a T in it, like a T like Tom, because everyone spells it wrong, even me. Right. So it's www.yourmortgage, MORTGAGE, and then girl, GIRL.com. So the Your Mortgage Girl came to me one day when I really I'm also in the business of empowering women and making sure that we support each other. And, I'm your mortgage girl. I always say I'm Padi Goodspeed, your mortgage girl. And I like things done yesterday. That's my cheesy line.
Love it. Love it. Do you have any last words you want to tell the listeners before we get off?
I don't. I think, last words. I think that it's important that we all get excited about this conversation, that we take this market by storm. And one thing to remember is that the dollars that we have today will be less valuable over time. So we have to do what it takes to invest and buy property. Buying property is one of the only ways that many of us have to establish any sort of generational wealth. And it doesn't matter how long it takes for you to get there. I was a young girl, like I told you, I worked since I was 14 years old. I built up my entire life. I had the most incredible foundation that you could imagine. And then I got married at around 21 years old. I met my ex-husband when I was around 21. And at 30, I was divorced. In that time frame, I lost a lot. And those are mistakes that we make in life. And I've gained it all at a young age, lost it all at a young age, and spent the last 10 years rebuilding myself from the ground up. There's literally not a single struggle that we've talked about that I haven't personally persevered through myself. So I'm not speaking from the perspective of an elitist or a expert or anything. I'm just a human being who's trying to figure it out as we go. And it just so happens that this has been my only job for the last 18 years. So I know what I'm talking about. Other than that, I'm nothing. I'm nobody. I'm no one to look up to. I'm no one to put on a pedestal. I'm here on this journey with you. I think that if we can really empower each other to take the steps that's necessary to look deep within ourselves and solve the problems we have within management of our own selves, our own finances, our own credit, our own spending habits, our own saving habits, our investing, our education, then we're going to make the next 10 years better. I always say that the next 5 years are going to fly by just like the last 5 did.
Yes.
So now is the time to get changes and do what you got to do.
Yes. Oh, that was awesome. I can't even come behind that. I mean, thank you for being a light. Oh my gosh. And I'm looking for your book. Like, even though you think we shouldn't put you up on a pedestal, you are really great and motivating.
Man, I'm really good in these one-on-one settings. I get really nervous talking in public, and I don't know if I'll ever write some sort of book or anything, but I can tell you this, it'll depend on what I personally accomplish over the next 10 years, because I myself push myself the same way I push everyone else. My daughters think that I'm harsh sometimes, but I never hold anyone or anything to a standard that I'm not pushing myself to. We're not perfect. Every single person you're listening to on any podcast or on any clubhouse setting or on any social media platform that seems to be so far ahead in life, they're all just winging it. We're all winging it.
We are.
It's the way that we feel about ourselves that makes it seem like what they're doing is so much larger than life. So I challenge myself and I challenge us to think highly of ourselves. Think better of yourself, because when you do that, you're going to feel the confidence to get in the game. There's not a single book that you can read that's going to teach you what experience will teach you. Just get out there and try it. Fail, get slapped around, do what you got to do, but just keep getting back up. If I can tell you the amount of times I've gotten my nose broken from a punch straight to the face, you would be like, why is she still here? She should have gave up a long time ago.
I love it. Just keep going. Just keep going.
Just keep going. Yeah. Like the most simple advice people give you is don't quit, right? And until you accomplish something that you thought was impossible, you won't even understand what it means. Because every single time you wanted to cry in your pillow and you wanted to give up on something, every single one of us go through that.
Yeah.
Every single one of us go through that. And so every day you just decide to get back up. That's just it. Just get back up and keep going.
Just keep going. Oh gosh. I got to get you to come back. We got to talk about maybe have financing advanced level or something. I don't know, but I got to get you back because this conversation was so great.
Perfect. Good. Well, I'm excited that we're talking, and thank you so much for having me. Thank you.
Yes. And how can we find you on social media?
It's just Padi Goodspeed. My full name, PadiGoodspeed. I always say my last name is like Godspeed with 2 O's.
Love it. Love it.
Perfect.
To learn more about Padi, just go to our website, lightinguprealestate.com. If you like this conversation, leave a review, subscribe, and share with someone that you know. That's all for now. Stay safe, stay sane, and stay lit.